Hello again, everyone. Don Singletary. This is video number 4 of a 4-video series called Beginning for Day Traders, the pathway to trading for a living by learning to day trade the micro futures. So welcome along. In the previous video, we talked about getting your trading plan and how to practice honing your reward risk ratio and fine-tuning your win rate so that you can consistently make money without losing more than you make. And by the way, this is the last video on this playlist, but be sure and subscribe to the channel because I've got lots of great videos coming up, and you'll get a notification if you hit the bell up there too, so you can know when the new videos come out. Today, something very special. I had a plan this morning, and then I watched the market open today, and I saw some opportunity to point out some great things, especially to beginning traders, about the kind of psychology and trading decisions you go through when you're using the candlesticks and the MACD trade signal indicator. So let's get started. Standard setup, NASDAQ100 Micro Futures, 9:30. The market opens. You can see in the first 5, 10, 15 minutes the market opens, it starts going down. See the red candlesticks headed downward. And then a sharp turnaround at 9:45 a.m. See that pointy down on the bottom there? A whiplash where the market just turns around in 5 minutes and goes way straight up. Now, what happened is we get a buy signal over here, but not until 10 o'clock. We wait until the green line is well above the red line for a very clear buy signal. See that there? Okay, now as a trader, we have no idea what's coming next in the market. We're in the NASDAQ100, long one contract at 82.26. We're up 10 points, that's $20 at 82.36 at around 10:30. Now, I had said before in previous videos that I recommend beginning traders start with the NASDAQ100 because it's $2 a point. So let's talk about some choices you would make at this point in the trade. Okay, we're trading the NASDAQ100, $2 a point. We're up 10 points. From 10 to 10:30, from 82.26 to 82.36. So what do we do now? Well, we could put a stop limit on this order and buy it back if the market goes back down where we entered. And the worst thing could happen then is we'd break even. Of course, we're not in business to break even. We want to try and make some money. So we could take the $20 profit now in a half an hour and say, well, that's not too bad, and then go look for the next trade. But I want to talk to you about how you can set up a trade to have more choices. Now, at $2 a point, 1 point's not a lot of money. So we're going to try a different strategy here where we start off by buying 2 contracts instead of 1. Here's how it works, okay? 10 o'clock, instead of buying 1 contract, we buy 2. By 10:30, we're up 2 contracts, 10 points, that's $40. So we liquidate one of the contracts, put $20 in our pocket, and now we go down and put a stop limit order on the remaining contract that we're long at 82.26. This means the worst thing can happen all day is we're going to make $20. And in the meantime, we can leave that other contract there and see if it can go for a ride and make us some more money. And as luck would have it, it's typical in trading, you get some convergence in the MACD indicator that the day's trend for going up could be losing some of its momentum as the green and red line look as though they're about to converge. But remember, the trend is your friend, and the major trend this day is still up because those indicators, that red and green lines are between 3 and 4. If they were down at that 0 line below, it could be a trend reversal, but it's not shown here. So that's a good thing to remember when you're trading. The trend is your friend. Don't short something on a day when the trend is up, and don't buy something on a day when the trend is down. If you violate that rule, it can add as much as 50% risk to your trade. So that's a very, very important point to remember. So I'm going to clear the markers off the chart here, and we'll go back to 11:10, 11:15 when that green line went below the red line. Now, what that meant was we have less momentum, but we have less positive momentum because the crossover still happened up there between 3 and 4 in the right side MACD scale you see there. And for the next hour, hour and a half, as indicated in the purple rectangle up top, Prices did not go down. They stayed the same and generally went up during that time, even though the green line was below the red line. And just so you know, whenever a crossover between that red-green line happens, a crossover, if it happens down on the zero line, that can mean a trend reversal. But in this case, it was just less positive momentum and prices continued to go up for the day. Now this chart coming up is a different day, but it's another example of how we can lose momentum on an uptrend day. And we can see the green line go below the red line. However, the prices still stay level. They don't go down and probably even continue up during the afternoon. And you see the MACD indicator on the right. The momentum went up over 8. It's pretty unusual. It's very high. And so even though it crossed over and looked as though momentum was decreasing, it was. We still had a great deal of positive momentum in the afternoon. One of the most frequently asked questions by beginning traders is, how often should I be trading? Should I be trading 2 times a day or 5 times a week, or exactly how does that work? And one thing you can do is go back at your trade log and look, and there may be some clues there that might fit your particular behavior. But before I go any further with this topic, I want to explain something very important. I'm a lucky man. Many years ago, I had a genius mentor who was a whiz at trading futures and made lots of money always. And I asked him one time, and I said, Phil, I'm making 10, 15, sometimes 20 trades a week. I'm working really hard. I'm not making any money. I'm not losing a great amount, but I'm just not making any. I'm getting paid very little for the time that I put into it. And I said, sometimes I feel like if I only made 2, maybe 3 trades a week, I'd probably make a lot more money. And being the genius that he is, he turns to me and says, well, why don't you do that? Phil was absolutely right. I made a rookie mistake that most beginning traders make, no matter what kind of trading they're doing. I had invested a lot of time and money, bought some very expensive books and software, and I'd gotten all dressed up, and I showed up when the market opened and thought I should start trading right away. Big mistake. 80% of the trades I was doing weren't necessary, and those were the ones that were losing me money. I call it the all dressed up and no place to go syndrome, because it just doesn't make sense to do all that preparation. You think the market owes you the opportunity for a good trade if you show up prepared and you've done everything you can. But the market really doesn't care. For years I had a trading buddy, and we would call each other after the market closed every day, have a good exchange about some trading ideas and things. It's always fun to have a trading buddy to talk to, and it's always a lot easier to see mistakes they make rather than to see our own mistakes. This guy calls me one afternoon. He has a farm background from the Midwest. Great guy. He phoned me, said he'd made some calls to farm friends in the Midwest. I said, why? He said, because I lost a lot of money on soybeans this morning. He traded soybeans year-round, and he said he studied the charts, made some calls to some farmers he knows in his old town, and he swore to me he'd get that money back. And I recognized what he was doing because I've done it. I call it revenge trading, and it's really a bad habit and almost always a losing proposition. Every day's new, every day's different, and the markets are truly, indeed, totally impersonal. I mentioned in my book, in the chapter on the psychology of trading, most of us are taught in our youth to always be optimistic, hopeful, have a rosy outlook, and to look for the best in a situation. Well, don't do it in your trading, because hope is not a strategy. It will lose you money. It's hard enough, while it works very well in personal relationships and social situations. Hope is a lousy trading plan. It just doesn't work. And remember, as I discussed in the book quite a bit, our brains are hardwired to find patterns in almost everything we see, like looking in the clouds. Channel 4 posted this picture of a Pooh Bear on his back. Now, you and I both know it's just water vapor floating in the air. But our brains always look for patterns and ways to trick us, and being aware of that is the first step in trying to avoid it. There's a link below if you want more information about the book and you haven't seen it yet. Coming up on the Day Trading Micro Futures channel are some new videos, some on candlesticks and how to use them to make better trading decisions. Also, one on money management and how to avoid the most common trading mistakes, and trading multiple contracts and how trading those multiples can allow you more opportunities for profit in your Micro Emini trading. Remember to keep a trading log of all your practice trades until you can make 25 successful trades in a row before you put your hard-earned money at stake. A successful trade can be a winner or a loser. It's a winner if you don't give all the profits back and you're able to keep them, and you don't take your profits too soon so that you limit them too much. And the other most common mistake, of course, is letting your losses run. So keep that trading log. Be patient with yourself. It takes time to learn the disciplines here, and it really does take some effort. This kind of trading isn't for everyone, but it's really a lot of fun, and you can learn to make profits consistently. This is Don Singletary. I hope every day is a payday for you. Thank you.